More or less exactly a year ago, I crossed the £100,000 mark for my entire investment portfolio. Well, now a year later, in February 2025, my total investment portfolio has just crossed £150,000. That's a massive number. I don't really feel any different day to day. I'm still, of course, working a 9 to 5 and then doing Making Money Simple on the side. But I'm grateful at 27, nearly 28 years old to have that amount invested. And of course, it will continue to compound for decades to come. So in this video, I'm gonna be running through why the first 100K is the hardest, a bit about my investing journey and investing mistakes, and also what I did, the main things that moved the needle to build this pot. And I should obviously say this hasn't happened overnight. It's taken the best part of 8 years, and I'm also not a genius. I haven't done anything special. I haven't inherited any money. It's all, as we're gonna get onto, mainly my own contributions from my income. My income mainly being, as I already mentioned, my 9 to 5. The first £100,000 invested is the hardest, and a quote on the screen is from the legend himself, Charlie Munger. He said this though in 1994. So of course, £100,000 back then is worth a lot less now. I plugged this into the Bank of England reverse inflation calculator, and £100,000 back in 1994 is worth £207,000 now, although saying the first £207,000 probably doesn't have quite the same ring to it, unfortunately. But the point still stands, and this is exactly why the first £100,000 is the hardest. Why? Because it's mainly your own contributions to get to that point. This is gonna sound counterintuitive, but the rate of return in your early years of investing is almost irrelevant. But then once you get to that £100,000 point, a good year in the markets can just massively increase your wealth. Let's take last year, for example. Global stock markets were up about 20% across 2024. If you had £10,000 invested, that's brilliant. You would have made £2,000. But if you had £100,000 invested, you've then made £20,000. The average salary in the UK is around 30 to 35 grand. So you're almost making the average salary in the UK just from investing and doing nothing. I'll show you an example in a second, and I probably will make a full video on why the first 100K is the hardest, but the main reason is because it just takes hard work and consistent investing and saving to get to that point. But then once you do get to that point, the market then starts doing the heavy lifting for you to build your wealth exponentially over the long term. Let me talk you through a specific example. Let's say you're investing £500 per month and you're earning 7% per year, which is roughly the long-term after inflation rate of return of the broad stock market. To get to that first 100K, so you're starting with £0 and putting in £500 per month, it would take you 11 years and 3 months. Now that's a long time, over a decade of consistent hard investing. However, to go from 100K to then 200K, it will take you 17 years and 6 months. So that's an extra 6 years and 3 months. So it's taken you just over 11 years to get that first 100K, but only a further 6 and a bit years to get to 200K. To then go from 200K to 300K, it's a further 4 years and 5 months. And this is once again just assuming you're putting in £500 per month and average return of 7% per year. So it's taken you an initial 11 years, 3 months to get to 100K, but then after another 10 and a half years, you've got to 300K. And you can see where I'm going with this, but to get to 500K would take 28 years, and then get to £1 million would take just over 37 years. And this really just shows the power of investing and compound interest. But in this example, it's taken you 11 years to get to that first 100K, but then to go from 500K to £1 million, it's only taken you 9 years. And that is why the first 100K is the hardest, because once you have that, the market will start doing the heavy lifting for you. There will still be crashes and dips along the way, but you've got that foundation from which your wealth can just exponentially increase from over the long term. I probably talked about that a bit more than I wanted to, and I will make a full video on it. But now let me get into a bit about my investing journey, my investing mistakes, and also how I built this portfolio. And hopefully some of this can help you build your own investment portfolios over the coming years. I originally accidentally got started investing in 2017 when I was auto-enrolled into a workplace pension. I was working, doing a placement year in between my second and third year of uni. I got auto-enrolled into a pension, and I didn't even realize until a year later, but of course that money in my workplace pension was my money and it was being invested. It wasn't until about a year later in mid 2018 when I finally started taking steps to properly invest, as I call it. I started actually putting some of my net pay away into investments every month. Now I went back to uni, but I did manage to set up a stocks and shares ISA, and I was putting in £100 a month from some of the money that I'd saved through working for that year. And it's safe to say the first couple of years, my investing portfolio grew relatively slowly. I was only putting away 100 quid or so a month, and I made a load of mistakes, as we're going to come on to in a minute. It was then in September 2019 when I went onto a grad scheme and properly started working. At this point, I was renting in London, so a decent chunk of my paycheck was going on that, but I was actually now earning like money so I could actually invest more. And I started by upping my contributions into my stocks and shares ISA to £250 a month, and I was also getting a 6% employer match. So every month I had money going into my stocks and shares ISA and then 12% going into my workplace pension. And that from September 2019 is really when my wealth, I guess, or my investment portfolio started to grow. Particularly when I then qualified as a chartered accountant in October 2021, I got a massive 35% or so pay rise. So I upped my contributions in my stocks and shares ISA to £650. At this point, I was also putting a little bit of money into crypto every single month, and I was still getting that 12% employer match in my workplace pension on this new higher salary. So I was sort of doing the exact same thing in 2019 that I was doing 2 or 3 years later. It was just I was earning more money and I prioritized investing so I could put away more each month in my accounts, and that generally was my workplace pension and my stocks and shares ISA. And that sort of has been the story from 2021 to 2024. My salary's generally gone up slowly over time as I've got promoted at work, and as my salary's gone up, I've done my best to avoid lifestyle inflation and invest more. So most of my contributions have really come directly from my 9 to 5 working as an accountant. But I did also manage to increase my income, and that's mainly through doing Making Money Simple. Whilst this still isn't my full-time job and it makes me nowhere near as much money as the full-time job, I've been able to make money from it over the last 6 years that I've been doing it. Mainly over the last 2 or 3 years is where I've made money, and I've used that money to either contribute to my SIP or pay myself a dividend that I can then invest to put into my stocks and shares ISA. And that really has been my investing journey. I'm going to come on to the 4 things that I did that moved the needle the most in building this £150,000 plus pot over the last 8 years. But essentially it's been increased salary, increased contributions, increased salary, increased contributions, and doing that every single year for years and years. And it's worth saying I've now been invested in the markets for nearly 8 years. So there's been some capital gains, some dividends, some compound interest, and all of that has helped to build my pot. However, I did make a lot of mistakes, as I alluded to earlier on, and these were some of the big ones that I made on my investing journey, particularly at the start, that you should try to avoid. Firstly, I opened up an investing account with a high street bank. This was the high street bank that I banked with, Halifax, because I thought you had to open up an investment account with the company or the bank that you held your current account with. This is obviously wrong, and generally speaking, for most people, it's best to use a dedicated investment platform. So thankfully, a few months afterwards, I found Vanguard. Secondly, I had no idea what a pension, although I accidentally had one through work, or a stocks and shares ISA was. So I opened up a general investing account, and that has no tax advantages. Fortunately, once again, I then discovered a stocks and shares ISA and started using that, and I already had a pension, and I understood that the pension is actually my money and it's being invested. Thirdly, I then made loads of mistakes when it actually came to my investments. I invest into high fee active funds. I tried to pick individual stocks and time the market. Doing all of this, paying massive fees, all big mistakes. Fortunately, I discovered index funds. So when I really started investing, I made a load of mistakes, bad mistakes in the first few months, but then it all sort of came together, fortunately, relatively quickly. So after about 6 months, I then had my global index funds in my stocks and shares ISA and pensions, but at the start it was a little bit messy. On top of this, I was paying high fees when I was investing. I was investing based on online tips, which is stupid. I was checking my investment portfolio way too often. So I made a load of mistakes in my first few months, and if you can avoid any of those, that'd be beneficial. And as I mentioned, I then very quickly settled on using ISAs and pensions, holding global index funds in both, and just contributing what I can. And literally that is still my approach today. Even now, I'm temporarily living in Australia and I'm following the exact same investment philosophy. People often ask me then, how did I actually build this? Well, there were 4 key things, in my opinion, that moved the needle. The first one, I actually got started. As you've already heard, firstly, I accidentally got started and I made a load of mistakes, but just getting started is the most important thing. Sounds cliche, but it's true. You can devise the greatest workout plan in the world. If you never get in the gym, you're not going to make any gains. And it's literally the same with investing. If you never actually invest, you're never going to make any gains from the market. So even if it takes you to start with £10 or £100 to make mistakes, you actually need to get started, or you're just never going to grow your money, and your money is just going to continue to sit in a bank, losing out due to inflation. Secondly, I utilize free money. What does this mean? Well, I actually made the most of my employer workplace pension. They match 6%, so I put in 6%. People opt out or don't put in the full amount. Don't do that. It's literally free money. If they match 5%, 10%, whatever it is, the more they can match, the better, and the more free money you have going into your investment pot every single month. Number 3, as I alluded to earlier on in the video, I avoided lifestyle inflation, and I think this is a really big one. Lifestyle inflation seems to be worse than ever. I know there has been cost of living pressures recently, and that's a bit of a different topic, but lifestyle inflation really is where as your salary goes up over time, so do your expenses. I don't want to big myself up, but I've done a relatively good job of keeping my expenses relatively stable. Don't get me wrong, I still have fun, still go on holiday, still do nights out, have a few pints of Guinness, but I've managed to keep my expenses relatively stable as my income's gone up so I can invest more and more. I've also, not that the bonuses are great in accounting, invested 100% of every single bonus I've ever got, and I'll continue to do that. And ultimately, by avoiding lifestyle inflation and investing more and more as your salary goes up, really is the key to sort of accelerating your path to building a big investment pot to one day live off of it. Fourthly and finally, and once again, as I've alluded to already, I've increased my income, both through actually work, my 9 to 5, by becoming a qualified chartered accountant, then by getting promoted over the years, and also through making money simple. I'm allowed to monetize this platform, for example, YouTube AdSense, and then over time using all of this extra income to invest more and more. Particularly when it comes to those early years of investing, and as we already touched on, getting to that 100K mark, a lot of it, almost all of it is going to be your own contributions. So that is why if you can increase your income and invest more, you can get to that 100K mark as quick as possible. It took me about 6.5 years to get there. And then from there, as I've already seen with my own eyes, with my own portfolio, the market really can be powerful, because when there is a good year, like there was last year, your portfolio can just blow up if you've already got a big base of, say, £100,000 sitting there. So I wanted to make a video on getting to £150,000. I hope this was helpful and was able to take some things away from it. My mistakes, my journey, how I got here, I hope it was all helpful. If you've got any questions at all, I'm always happy to help. So let me know in the comments below. I'll put another video on the screen if you want to keep watching some more investing content. And if not, have a great day.